Today, we're talking about 5 places to put your money besides the bank. Last week's episode was on which retirement accounts should you withdraw from first. So go back and check that out if you missed it. Today, we'll explore alternative options for safely parking your cash and potentially earning compelling yields. So let's dive on in. To most of us, our bank balance represents readily available cash for withdrawal and everyday use. But have you ever thought of it as an IOU from the bank? That IOU might not always be easy to honor, as recent bank collapses have shown. For balances under $250,000, the FDIC has proven to be an efficient operator, ensuring deposits and making them quickly available in case of bank failures. However, the insurance limit hasn't changed since 2008, and it's not indexed to inflation. But fear not, my dear pre-retirees, there are safer alternatives to consider that provide a level of protection and attractive yields. One option is FDIC-insured sweep programs offered by brokerage firms. These programs sweep your cash into FDIC bank accounts, insured bank accounts, sometimes across multiple banks for higher protection. Money market mutual funds, or MMMFs, are another option as well. They seek to maintain a share price of $1 and generate interest income. While not FDIC insured, they invest in high quality securities. Treasuries issued directly by the U.S. government are also considered one of the safest assets. Interest income from treasuries is exempt from state and local taxes. I want to throw in 2 more that's not in the article. The article doesn't mention these, but most recently, since the interest rates had increased, so did the rates on the fixed annuities and MYGAs, multi-year guarantee annuities. Many people have taken advantage of locking in these rates for a few years. Of course, again, this is for what we call lazy money, money above and beyond your emergency funds that's just sitting in a savings account, barely making 1%. Okay? Now, for those willing to take a bit more risk, short-term bond funds can deliver increased yields while still remaining relatively safe. Now, I know some of you might be skeptical about the stock market due to its risk, but consider this. Broadly diversified stocks have outperformed cash significantly since 1950. As your holding period lengthens, the risk of loss tends to decrease. Historically, the worst one-year return for the S&P 500 was negative 43%, but the worst 5-year return was negative 6.6%. And if you extend your holding period to 15 years, the worst return was actually positive at 3.8%. Of course, stocks are riskier, and it's important to consider your risk tolerance and financial goals before ever investing. So, my dear retirees and pre-retirees, there are plenty of options beyond traditional savings accounts for you to park your cash, from FDIC sweep programs and money market mutual funds to treasuries, short-term bond funds, and even diversified stocks, and my 2 bonus ones, fixed annuities and MYGAs. Each option has its benefits and its risks. So remember, it's always essential to consult with a fiduciary financial advisor to find the right approach that aligns with your unique circumstances and goals. To read more about this recent topic, click on the link below, and I really hope that you found this information helpful and exciting, and it prompted you to get motivated to take action to improve your financial future. See you guys next week, where we'll share another episode where we'll discuss what to do when a loved one dies. On Money Motives, good news from the world of finances. Stay motivated to find your way to your dream financial destination. See you guys next week.